Talking about IT earnings, we have Venkatraman N, Managing Director and CFO. Plus we have Joseph Anantaraju, the Executive Vice Chairman and CEO, Product Engineering Services at Happiest Mind, joining us to make sense of their earnings because they too have increased their guidance for the full year. Venkat, hi, good afternoon. Thank you so much for making time. That's exactly my first question. You've actually raised your guidance when a lot of other peers of yours are talking about apparent headwinds. What are you doing differently and what gives you this confidence?
So, talking about FY23, we just finished our quarter. We've shown a constant currency growth of about 7%. So that's really industry-leading number, and that talks about the fundamental depth of the business and the demand that's out there for us to cater to. That's what made us look back at our own numbers for the quarter and for the year rather, and also for the longer term, and basis which we have now upped the guidance on the revenue to about 25% for FY23, and a similar 25% for the 5 years after FY23. Earlier, we used to talk about revenue guidance, splitting it into organic growth, inorganic growth, and all of that. All of that has been done away with. We are now sticking to a number of 25%, and that's it's higher than the 20% number that we used to earlier talk about. So that's on the revenue growth and the guidance and the confidence that we have in achieving those. If you look at all the verticals and horizontals, this and geographies for this quarter, in absolute terms, they have shown growth. So that's also the added reason for our increase in guidance.
Right, Venkatraman, this Cheryl also joining in the conversation. No doubt you've gone ahead and raised your revenue guidance, but you've actually maintained your margin guidance. And this, despite having beaten the guidance quarter after quarter for the margins that you've set. Are you being conservative, or do you actually see margins slipping below 25%?
As far as margin guidance are concerned, we have always been talking about a 22 to 24% on a sustainable basis. We continue to hold that number. Particularly this quarter, we had gains on account of foreign currency impact, rupee, because almost 78% of our business is in dollar terms. So we were not impacted so much by the cross currency. In fact, we got some favorable movements on account of rupee devaluing versus the dollar, which also coupled with operating improvement, we have been able to maintain margins at 26.4%, which incidentally today is industry leading and in line with the mid and the very large companies. But as we look forward into the quarters, there is a pay increase that's likely to happen. This is going to happen next quarter. We are also looking at some adjustments in costs with travel coming back, benefits of credits that we used to get during the COVID time, because we were getting rental credits and other expense credits, which are no longer there. We expect those costs to come back, and all of them, when baked into our P&L, we think 22% to 24% is a realistic number to keep in mind. Most importantly, we are targeting for growth which is profitable. But to make sure that we have growth, we have to also make investments in new technologies, in new verticals, addition of people ahead of time in technologies and verticals. And we will not hesitate to do that. So giving a high guidance of, let's say, 26 or 27%, and then not making the investment required would be disastrous. So these are the things that have been considered while sticking to the guidance of 22% to 24% on a long-term and sustainable basis.
Sure, Venkatraman, that point is taken. But Joseph, coming to you now, how was the deal win momentum this quarter? And if you could throw some more light in terms of which geographies or verticals is driving growth for you?
So, what we, as Venkat mentioned, what has been happening is that our growth for Q1 has been broad-based, whether it's from a geo perspective or verticals. We've seen all of them exhibit growth. Now, as a percentage of revenue, there could have been movements because one revenue or one geo could have grown at a faster pace than the other geo. And what we're seeing out in the market is that the demand continues to remain strong. while customers are keeping a close watch on the geopolitical and macroeconomic situation, they realize that many of the digital initiatives that they've started, they need to continue investing in these and take them to completion just to remain competitive. And they're looking at how they can make the budget available for these digital initiatives. And therefore, we've not seen any flag off in terms of demand in the market so far.
Joseph, let's get a bit more specific then, and let's talk about the European markets. Are you seeing any demand pressure in European market?
We've so far not seen any in the customers that we are working with. In terms of Europe, we have presence in several verticals, and we've seen that all of them are continuing to sustain the digital initiatives that they've started, the technology upgrades and modernization that they've embarked on. All of them they are continuing with. And what we've seen is, in case they need to look at multiple initiatives and prioritize, that reprioritization that is happening. But the overall spend, we've not seen any flag off, as seen in the Q1 results, and our confidence in upping the guidance and giving a guidance of 25% for this year.
Sure, gentlemen, but client addition and client mining has been one of your key focus areas. Talk to us about how that is shaping up, what kind of client additions you have seen this quarter.
Yeah, so in terms of client addition, we had 5 new logos that we were able to add, and this is spread across both India and North America geo. And as you would have seen, we've been able to move, in terms of expansion, we've been able to move one of our customers from the $5 million category to the $10 million category. And in many of our customers, we are seeing growth, expansion into other business units, and getting into newer initiatives with our customers. We have our vertical and domain expertise being built so that we can assist in these capability in these pursuits. And as we had mentioned earlier in our conversations, that's been an area of focus for us, building more depth in our domains and verticals so that we can work with our customers to transform or translate their business objectives into a technology roadmap and help them, with their growth story.
And also, our average revenue per customer, which was about $794,000 last quarter, has moved up to $810,000. So we've been talking about land and expand strategy, and this is a result of continuously working on that one.
Right. Let's talk about then the attrition level, gentlemen. Where do you see attrition headed going ahead? That's a sore point for almost all the tech companies. Also, let's talk about employee addition. What's your outlook on that particular front?
So our attrition for the quarter was around 24%, and this is in line with industry, and this is a pretty warm, hot market, I would say. Though we are seeing signs of the market becoming a little bit more, I would say, rational. And in terms of net addition, we did add 24 people last year to our headcount, and we are expecting a huge increase in Q2. We have a campus batch joining, and we have a pretty good joining pipeline. And so we'll continue adding, focusing on adding people to sustain our growth. In terms of attrition, we have our pay increase happening in July, and we've taken stock of the market conditions, and accordingly we've done the budgeting and the increment, and we've just come back to office, back to smiles. We are week on week, we're seeing more people coming in, and what we've seen is that the attrition rate in people who've joined during the pandemic is very high. So we are encouraging people to come back to office so they can meet with each other, interact, and we are increasing our people engagement activities to reduce the attrition levels.
All right. Thank you so much, gentlemen. We leave it there. That was Mr. Venkatraman N, who's the MD and CFO of Happiest